Morning, folks, and today's episode is called Bill Hwang, the fastest fortune ever lost. Hwang was once a star trader with Julia Robertson's Tiger Capital, and he then left and set up his own Asian hedge fund, only to fall into trouble, charged with insider trading. But he came out of that scandal, and then he built a personal fortune estimated at 20 billion. And he became known within Wall Street as the greatest investor you've never heard of. And then he loses it all within a matter of days. So, who was Bill Hwang? Where did it all go wrong for him? And even more importantly, at least for me, I love how this story shines a light on what is this ticking time bomb that I believe is going to result in another very, very serious financial meltdown. It's a cracking episode. Enjoy.
And just a quick reminder, while these shorter weekly episodes released every Wednesday are free for everyone, for just $1.99 a month you get access to our co-hosted hour-long episodes released on the first of every month, where Keith and I do an even deeper dive into an incredible business story. Some of these hour-long episodes are still free in our back catalogue, so you can get a taste of what to expect. Now, as well as getting access to these monthly co-hosted hour-long episodes, behind the paywall are additional bonus episodes. And over the coming months, we'll be adding more bonus episodes for subscribers regularly. Some of these are two-parters, some are three-parters, and some are standalone episodes. Also, as a subscriber, you can listen to these weekly episodes ad-free, so you won't have to listen to me telling you about our great subscription offer. And it is a great offer. For just $1.99 a month, you can subscribe via Apple subscriptions, Spotify subscriptions, or on Patreon using the link below, or go to patreon.com/Great Business Stories.
So, Bill Hwang, he was born, full name, Sung Kuk Hwang, in South Korea in 1964. He was the son of a Korean pastor. His father died when he was young, and in 1982, when he was just 18, Hwang emigrated to the United States. Now, he didn't speak a word of English, so he picked up a job at McDonald's, working night shifts to help pay his way through, and also, of course, it helped him practice English. He earned an economics degree from UCLA, and then he went down and got his MBA from Carnegie Mellon. And then he landed his first finance job as a stock salesman with Hyundai Securities in New York. But the real turning point, that happened when he moved to Hong Kong to work for Peregrine Investments Holdings. And it was while there that he came in contact with Julian Robertson. And if that name sounds familiar, it's because I mentioned him in our episode on short sellers. Because Robertson, as you remember from that episode, he wasn't just another hedge fund guy. He's a very, very intriguing character. So I'm going to do a very quick rundown of him, but I am definitely going to do a full episode on Julian Robertson. He launched Tiger Management in 1980 with 8.8 million. And 2 decades later, the fund was managing 22 billion. And the returns after fees averaged 31.7% a year. That was compared to the S&P's 12.7% over the same stretch. So massively, massively successful. And his strategy was what was called a long-short equity. So he'd go deep, deep into research. He'd pick winners, bet against losers, and then he layered what they called was microeconomic thinking. So it was a very rare mix, and it worked. But in the late 90s, Tiger, it started to slip. And we mentioned this in the short seller episode, because Robertson stayed away from the tech craze. And while that decision, it was proved right in the long term, at the time, it really crushed short-term performance. And from 1997 to 2000, Tiger funds dropped by 40%. And there were missteps too. They took a hit on US Airways, and there was a bad currency play on the yen. And by March 2000, Robertson announced the closure of the fund, citing, as we mentioned, irrational market behaviour for favouring tech stocks. And again, he was proved right. And although he was vindicated when the bubble burst, it marked the end of an era for Robertson and the Tiger Fund. But, that said, Robertson's impact didn't stop, because his real legacy were his protégés, the Tiger Cubs they were called. These were the people he trained, and they went on to run some of the biggest hedge funds out there. And even after Tiger Management closed, Robertson himself, his own investing continued. And it was very, very impressive. In 2007, he pulled in a 76% return. he also shorted subprime. So from the time the funds closed, the Tiger fund closed in 2000 to early 2008, his personal portfolio surged by 403%. And then there's his philanthropy. He gave away over 2 billion. He signed the Giving Pledge. That's the one that was started by Bill Gates and Warren Buffett, committing to donate the bulk of his wealth. And Julian Robertson died on August 23rd, 2022 at the age of 90. But he left behind this legacy that wasn't just about money. It was about ideas. It was about mentorship. It was about values. And in that world, in that hedge fund world, he really set the bar. And as I mentioned, we're definitely going to do a full episode on this guy. But back to Bill Hwang. Robertson saw something in him. He called Hwang the best salesman he ever met. And I'm guessing Robertson would have met an awful lot of salesmen in his time. So he offered Hwang a job in 1996. Hwang was then 31, and he became then one of the Tiger Cubs. As I mentioned, they were these young, ambitious, very, very talented. Like within that group, I did a bit of research. Out in that group came Chase Coleman, who went on to found Tiger Global Management and has a current net worth of 6 billion. Also within that group, Andreas Halverson. He founded or co-founded Viking Global Management. He has a net worth of over 8 billion. But within Robertson's Tiger fund anyway, Hwang was the one who brought him into the Korean markets. And in 1999, Hwang pitched the idea of investing in ST Telecom. Now remember, this is at a time when Robertson's fund was underperforming. But Tiger invested in this recommendation from Hwang. They snapped up 6.6%. And within just a few months, that investment returned a profit of 555 million. So a massive win. And for Hwang, it really helped seal his reputation inside in Tiger. Robertson even called him, and I quote, the Michael Jordan of Asian investing. So that's how highly he raised him. So when Robertson decided to shut down Tiger, he made sure that his legacy lived on by backing his top proteges, the Tiger Cubs. And Hwang got 25 million check from Robertson to start his own hedge fund. And he called that hedge fund Tiger Asia Management, launched in 2001. Now, as you can guess, its focus was on China, Japan, Korea, and the timing was good because the region's economy was booming. And by 2007, Tiger Asia, it was flying. The fund had close to 8 billion under management. Annualized returns were clocking in at about 40%. And that made it one of the largest Asia-focused hedge funds in the world. And Hwang wasn't really shy about how he played the game. He took huge concentrated bets, he leveraged positions. It was bold and it paid off. But then came 2008, the financial crisis that hit everyone, and Tiger Asia was down 23% that year. But in 2009, Hwang bounced back, posting a 3% gain at a time where most financial institutions and hedge funds were still in the doldrums of the financial crisis. So Wall Street took notice. The big banks took notice of how he found opportunities and made them work. But then 2012 came along, and that was a big turning point because that year the SEC charged Tiger Asia with insider trading. They'd short sold Chinese bank stocks using private, confidential information, and it netted them a 16.7 million profit. But it was illegal. I mean, it was a cut and dry case. Hwang and the firm agreed to settle. They paid 44 million in penalties, and Hwang got a 5-year industry ban. That was the end of Tiger Asia. But here's what didn't happen. Hwang never had to admit personal guilt. And all he got, really, was a slap on the wrist. And look, if you've listened to our episode on the LIBOR scandal, you already know how I feel about these kind of settlements. To the public, they look like victories. Sure, big fines, headlines, prosecutors patting themselves on the back. But here's a guy who made 16.7 million through insider trading. That's not a grey area. That's, it's not a misunderstanding. That's a cut and dry crime. And his punishment, a fine. No jail, no personal admission. So what's the incentive not to do it again? I always believe, and I know I harp on about it, but these settlements, they send a very clear message. If you're rich enough, you can pay your way out of justice. And in the finance world, they barely leave a dent. Hwang's reputation as a brilliant investor, it didn't disappear. His inner circle still admired him. Even Julian Robertson, who I think I admire. I have to do a deeper dive on him, but he stood by him. He said, I'm a great fan of Bill, and it could probably happen to anyone. I mean, sure, it could happen to anyone willing to break the law. And that's the problem. Because inside the industry, a lot of this stuff, it doesn't feel like a crime because there's no punishment, like what happens for other criminals. For Wall Street, it's the cost of doing business. And the regulators, the government, well, they let that culture fester. They accommodate it. And as we'll see, this then just results in bigger problems. But anyway, I digress. Let's get back to 2013. Bill Hwang, he tries to wipe the slate clean. He took what was left of his money. He's still around 200 million, so not bad. And he launched something called Archegos Capital Management. Archegos is the ancient word for leader. So this wasn't a hedge fund though. This is what is called a family office, which meant he was managing his own wealth, no outside money. And because of that structure, Archegos operates with way less regulatory oversight. No need to file the same forms, no like pesky investor disclosures. It flew under the radar. So what are these family offices? I decided to take a look at it and I found out that they're not really niche anymore. Like by 2030, they're projected to manage over $5.4 trillion. That's more than the entire hedge fund industry. So these family offices are becoming increasingly powerful. And yes, they're largely invisible in terms of regulations. Now, Archegos built its trading strategy around something called total return swaps, a sophisticated derivative. So let me explain them in terms that I can understand. So picture renting a house instead of buying it. You hand over a small security deposit, you move in, and you enjoy all the capital gains if the neighbourhood booms and pay the owner a floating rent tied to short-term interest rates. But if the roof leaks, i.e. if stock price tanks, you're on the hook for the repairs. The owner, the bank, still holds the legal title, but you, the renter, in this case Archegos, pocket every dividend and price uptick. That's the entire total return. Like in swap speak, you receive the asset's performance, the bank receives a steady financing fee. Now, the use of these complex derivatives, it always makes me nervous. We've seen this before. Remember those derivatives used for mortgage contracts that were front and center during the financial crisis in 2008? But anyway, here's why Bill Hwang loved these return swaps. First of all, he could leverage on the cheap. Because the swaps required only a slice of cash as margin, sometimes less than 15 cents on the dollar, Hwang could control a 100 billion plus portfolio with a fraction of that capital. There was also, a second reason, a cloak of invisibility. Regulators track owners of the stock, in other words, the banks, not the people who take out the swaps. So the shares sat on the bank's books. So there was no filings, no 5% ownership alert, no headlines screaming one man is cornering the market in certain shares. And operationally, it worked like this. Hwang's office phoned the desks at Credit Suisse, Goldman Sachs, Morgan Stanley, Deutsche Bank and said, buy me 1 billion in Viacom CBS, give me a TRS, a total return swap. The bank executed the trade, parked the shares in its own custodial account and struck a swap. Every quarter, Archegos collected all the dividends and mark-to-market gains while paying the bank a small fee or commission. And crucially, each bank or institution that Hwang dealt with saw only what he was trading with them. They didn't know he was doing the exact same with other banks.
But Hwang didn't stop at betting big. He borrowed big too. For every dollar of his own money, he borrowed 4 more. That's a 5-to-1 leverage ratio, which is huge. And it meant he could control massive amounts of stock, far more than what his actual capital would allow. And it also meant, though, that a small drop in prices could blow the whole thing up, and fast. By 2020, Hwang's net worth was estimated to be about 20 billion, and most of it was tied up in these swaps. But thanks to all that leverage, the firm had its hands on positions worth many times that. At its peak, its total market exposure was about 100 billion. And at first, the bets paid off. Archegos locked in on tech and media. Viacom, CBS, Discovery, Netflix, and also some Chinese tech firms. And the returns were massive. For example, they netted 1 billion on their Netflix position alone. So Wall Street was taking notice of this, like the big banks were lining up to offer their services. And Hwang's reputation as a stock picker soared. The CEO of Galaxy Investment Partners once said, "Bill Hwang is the greatest investor you've never heard of." And just a quick reminder, while these shorter weekly episodes released every Wednesday are free for everyone, for just $1.99 a month, you get access to our co-hosted hour-long episodes released on the first of every month, where Keith and I do an even deeper dive into an incredible business story. Some of these hour-long episodes are still free in our back catalogue, so you can get a taste of what to expect. Now, as well as getting access to these monthly co-hosted hour-long episodes, behind the paywall are additional bonus episodes. And over the coming months, we'll be adding more bonus episodes for subscribers regularly. Some of these are 2-parters, some are 3-parters, and some are standalone episodes. Also, as a subscriber, you can listen to these weekly episodes ad-free, so you won't have to listen to me telling you about our great subscription offer. And it is a great offer for just $1.99 a month. You can subscribe via Apple subscriptions, Spotify subscriptions, or on Patreon using the link below, or go to patreon.com/Great Business Stories. But, of course, behind the curtain, things weren't looking so good. One former employee called it a time bomb waiting to go off. Like all that leverage, all those massive concentrated bets, it was massively risky. And the key point here that I really need to stress is that Hwang was doing 2 things that were not at all kosher. First of all, he was manipulating the share price of the stock he was holding. Now, he did this by flooding capital into thinly traded names like Discovery, Viacom, CBS, and those Chinese tech stocks, so it looked like real demand. So this was a self-fulfilling prophecy of sorts. To everyone, it looked like real demand for these shares, but initially that demand was being fueled by Hwang alone, because as I said, these were very thinly traded stocks. So this kind of move, it's known as painting the tape, because it sends a signal that then draws in momentum traders. So then they start buying into the stock. Suddenly, a stock like Viacom CBS rockets from $12 to over $50. But it's not because, the earnings were good or anything like that, or the outlook was strong. And the subsequent rise in those share price gave cover for even more leverage with the banks. And this brings me to the second point, that he was also concealing his bets from the banks he was dealing with. So he placed the same bet with Morgan Stanley, with Credit Suisse, with Goldman Sachs, with all his banking partners, and each bank thought they had a big client with a big position, and none of them realized that he was making the exact same bet with several other banks. He hid that fact. From the outside, Archegos and Hwang looked like a genius, a fund like on fire. But it was a very, very carefully manipulated feedback loop. And of course, this was all great until it wasn't, because the end came fast. To March 22nd, 2021, Viacom had announced a $3 billion stock and debt offering. Hwang was due to invest $300 million in this offering. But at the same time, some of his Chinese investments were being hammered, so he didn't put in the $300 million into Viacom. As a result, because Viacom didn't manage to raise the full $3 billion, it led some investors to start selling it. The stock started to tank, 32% down over the next 2 days. And for Bill Hwang, like that drop, it was a nightmare, because Viacom CBS was one of his biggest, most leveraged bets. And he didn't have a very diversified portfolio. So he tried to fix it. He tried to double down. He threw more money at the problem. But the stock kept falling. And then came the margin calls from the banks, several of them, each thinking that Hwang had his very large position with them only. But Archegos didn't have the cash on hand to pay the margin calls. The leverage was so extreme, the numbers just didn't work, so the firm had no choice. It started dumping stocks fast, a wave of selling like that triggered this avalanche. March 26, 2021, just 4 days after it all began, Archegos officially defaulted. The margin calls just couldn't be met, and the banks, they all hit the panic buttons and started unloading everything. They all scrambled. They were all trying to unwind the exact same trades at the exact same time. Viacom dropped another 20% in a single day. Discovery, the same story. These were the stocks that Hwang had pumped, and like now they were collapsing, and the banks were stunned because all those return swaps, they'd hidden the full extent of Archegos's exposure. No filings, no red flags, like no warnings, and the scale of leverage only became visible after it all came crashing down. More than 100 billion in market value was wiped out. Now, the banks that moved slowest got hit hardest. Credit Suisse took a 5.5 billion loss, and it led to a wave of firings and reshuffling inside that bank. Nomura took a 2.85 billion hit. Morgan Stanley lost almost a billion. UBS lost 774 million. Goldman Sachs, they did move fast. They sold 10 billion in stock on March 26 and didn't record any losses. As a result, though, bank stocks around the world got hammered because investors were spooked. No one really knew how deep the damage might go. Well, I'll tell you, the damage to Bill Hwang, this time, it was pretty deep and very significant. His net worth, estimated around 20 billion, wiped out. Regulator and the Department of Justice all launched investigations. The allegations were serious. Hwang had misled the banks to secure billions. He'd used swaps to create the illusion of demand. He drove up stock prices, and when things turned, the whole system collapsed under its own weight. April 2022, Hwang and Patrick Halligan, the CFO of Archegos, they were arrested. Hwang faced 11 charges: security fraud, wire fraud, conspiracy, racketeering, market manipulation. His trial kicked off on May 6th, 2024. And like what followed was 2 months of real courtroom drama. This is when I first picked up on the Bill Hwang story, and the trial was pretty explosive. You had 21 witnesses, many of them former employees, and they painted a pretty brutal picture of what really went on behind the scenes. A former trader and a risk officer were the two main witnesses, and their testimony was explosive. I mean, the trader detailed how Hwang would instruct him directly to manipulate stock prices, especially right before the market closed. So those last minute trades created the illusion of rising value, which helped Archegos keep its massive leverage. Like it was a game, a lie. And Hwang, he said, was involved in every detail. He also said that they lied to the banks about how concentrated their positions were, about how liquid they were. They were flat out lies. So misleading counterparties, that was the business model. Banks were fed fake numbers about Archegos' portfolio, about their diversification, about their risk. And those lies got Archegos better loan terms, and with more firepower came more risk. These witnesses, they also described the culture within the office, like high pressure, no room to breathe at all. Here's a quote. Bill yelled at us. He raised his voice and he yelled at us that we can't go to the bathroom. Like, that's how tight his grip was. So it doesn't paint a pretty picture of Hwang, but I did some more digging on him, and in my research I came across other depictions of him, a totally different type of character, and this is really fascinating stuff. Hwang used to walk for hours through Central Park with his earbuds in, listening to Bible recordings. He was a very, very religious and spiritual person who gave to causes like most billionaires wouldn't even glance at. You're talking about quite conservative, deeply religious charities. No glamour. Very much like the owners of Forever 21, who we covered in a previous episode. And like them, religion was massively important to Hwang. And when he talked about how he invested, he said this: I try to invest according to the word of God and the power of the Holy Spirit. In a way, it's a fearless way to invest. I am not afraid of death or money. And again, like in the Forever 21 episode where the owners had no problem stealing designs or doing business with factories that they knew had deplorable work conditions, I don't understand how Hwang squares his blatant lying with his religious convictions. He also lived a very unglamorous life. You know, no private jets, no flashy cars. He took the bus, he flew coach. He lived in suburban New Jersey house that he bought for $3 million. So a very nice house, I'm sure. But for someone with billions and billions, very, very modest. Anyway, getting back to the trial. July 10th, 2024, after just a day and a half deliberation, the jury came back guilty, 10 out of the 11 charges. And then on November 20th, 2024, at the sentencing, judge called Hwang's actions unprecedented. He said the scale of losses attributable to your actions surpasses any I have encountered. And then he handed down the sentence, 18 years in prison, plus a 12.4 billion forfeiture order, 3 years of supervised release. Hwang, who was 60 at the time of sentencing, and who often came to his trial with religious texts, he thanked God, his wife, family and friends, and he said he was deeply blessed, and I also feel truly sorrowful for what transpired. Now, on a side note, Halligan, the CFO, he was sentenced to 8 years. So, what can we take from all this? Well, I know what I take from it. Much and all as I like the Bill Hwang story, like this exceptional stock picker, this deeply religious and humble man who turns into this lying bully of a boss when he's at work. I love that part of it, but you know my bugbear. The key thing that I get from this story is that in many ways it's just another chapter in the same book of financial scandals that could be nipped in the bud with better regulations. And more importantly, maybe, by treating so-called white-collar criminals more seriously. Now, Gary Gensler, the chair of the SEC, he said the Archegos story is a wake-up call for investors and regulators about the potential systemic risks posed by the use of derivatives by investment firms. And I agree. He's 100% right in this. Derivatives are a big problem. So they've reshaped finance over the past 25 years. Like, they've fueled market growth and they've created unbelievable wealth. But when they're misused, they are this massive, and I've used these words a lot, but they are a massive ticking time bomb. And here's why. First of all, leverage. They're instruments that let you control huge positions with just a sliver of capital, which sounds great until prices move against you, and then the losses can balloon so fast. And then there's counterparty risk. If one firm collapses, the damage doesn't stop there. It spreads. One default sets off another. It's a chain reaction. And another huge issue with derivatives, transparency, because a lot of derivatives don't show up in plain sight. They live in the shadows, and that's what makes them hard to monitor, hard to regulate, and incredibly dangerous. Now, if you want to go deep into derivatives, check out Gillian Tett's book called Fool's Gold. It's about how derivatives were first developed and how they helped spark the 2008 crisis. It's a brilliant book. It doesn't sound like it is. It is. It reads like a thriller. Definitely recommend it. Gillian Tett, Fool's Gold. Now, but coupled with the derivatives is the total lack of regulation overseeing these family offices. As I mentioned earlier in the episode, it's predicted that these offices will overtake standard hedge funds and reach 5.4 trillion by 2030. And I'm pretty sure that a lot of the interest in these structures is due to the fact that there's so little regulation. So that needs to be tightened up, and fast. And finally, it comes down to how we view and prosecute so-called white-collar crime. Like, what if Hwang had actually faced real consequences back in 2012? What if that insider trading charge hadn't been settled and he'd faced proper consequences for breaking the law? Could all of this have been avoided? And what if high-ranking financial executives faced prison for breaking the law? And look, I'm pretty liberal when it comes to crime and punishment, and I do believe more in reform than in prison. But at the same time, there has to be some equity in how we treat people who break the law, and allowing Wall Street criminals to settle their cases by paying big fines. I believe the perception of this, the action of this, it's so detrimental in so many ways. So there's a lot that needs to be done, some serious reforms, and until they happen, there will be another 2008 meltdown, except this time it will be even bigger. And it's for these reasons that I'm really interested in stories like that of Bill Hwang, and it's why it makes for such a great business story. I hope you've enjoyed it as much as I have. And remember, if you have any comments, any corrections, or any story that you'd like us to cover, email us at info@gbspod.com. All the best, folks.